Joining us is David Schwartz, analyst at Morningstar, and Scott Nations, president and CIO of Nation Shares. Good evening to both of you. David, your sector has, I don't know, gotten cheap or gotten sold off for good reason as people worry about the economy. Which is it? What are you telling your clients to do?
There are certainly good reasons why the stocks are down. I mean, many of them are down 40 to 50% in my area of coverage, which is mostly apparel retail and apparel manufacturing. And it is a difficult year. But the thing is, I think a lot of them are poised to come back in 2023. So I think a lot of them are oversold. There's really no reason why they should be down 40 or 50% this year. The expectations this year were really not going to be that high because last year was such a great year for many of these companies that it would have been almost impossible for them to match what they put up last year. So, I think a lot of them are oversold.
David, Scott, excuse me, what do you think? Because clearly there are worries right now with inflation starting to bite, with the retail inventories getting all messed up because of COVID, with the economy potentially facing recession. This has been a group. People don't want to buy Carnival Cruise or Etsy or Tesla or Amazon, which are also in this group. What do you think? Is there an opportunity here?
You're absolutely right. I think David is a little more optimistic than I am, or much more optimistic than I am. Sarah, you mentioned Amazon and Tesla, and if you look at the ETFs, the discretionary ETFs together, they make up nearly 50% of those ETFs, and those are companies that are very expensive. Amazon with a forward PE of 79, Tesla with a forward PE of 58. And so I'd much rather focus on the names in the discretionary sector that make or sell stuff that you really have to have anyway. And this highlights the fact that between staples and discretionary, there's a fair amount of overlap. But I've described companies that are in the discretionary ETFs like Home Depot, McDonald's, and probably my favorite name among all of them is Target. They all make or sell something that you have to have anyway. And you don't have to have a Tesla, but when I go to Home Depot, I need whatever I'm going for. So I think that those are really the places to focus. And Target, of the names I've mentioned, is by far the cheapest. It's got a forward PE of just 15.5. Lowe's is even cheaper, 14.5. Home Depot below 20. And again, Amazon, a forward PE of 79, and Tesla, a forward PE of 58. So I really think there's a dichotomy. So I would be picking individual discretionary stocks.
Yeah, the must-haves.
Rather than
you like the must-have discretionary. I know you're going to disagree, John, on the Amazon. Your boss, Bill Miller, is a big fan of this stock. What is your case for why Amazon is not expensive?
Well, tonight is Amazon Prime night, so we have football opening, and they actually have the TV package. So that's one thing. Obviously, AWS.
Is that a reason to like the stock?
Yeah, that's just
you're just throwing that out.
Yeah, throwing that in there. AWS is, kicking on all cylinders. They're obviously Prime, right? They have a recurring customer base all the time, just cashing, as well as the growth. The growth is going to continue going forward. So Bill thinks, it's a $3 trillion company in a little bit. He's still long and strong, the stock, and it touches so many areas. I think the one thing that people don't understand is that, obviously it's really solidified itself during the pandemic. I mean, people were getting cartons from Amazon every day, and thank God we had the technology that we did, so everybody could actually shelter in place and get all these goods
100%.
delivered. And that was a huge,
it was a game changer.
Thing. Yeah. And one last thing is their move into healthcare, which is going to be so disruptive that I don't think people are really.
People thought that about grocery, and it just never really happened.
But healthcare is so ripe for disruption.
All right, we're going to talk healthcare. Hang on to that thought, because David, I just want to get a final word from you, because you clearly think a lot of your names have gotten beat up too hard. What's your favorite? What do you think is too cheap?
I like Tapestry and Capri, both very heavy in handbags. Tapestry, the parent company of Coach, and Capri and Michael Kors. I also think Nike and Under Armour and Adidas are undervalued on the sportswear side.
Clearly not worried about the European risk there and the Chinese risk.
Well, there is. I think it's already priced in.
All right. Tapestry CEO on with me at Closing Bell tomorrow, 3 p.m. Shameless plug. David Schwartz, Scott Nations, thank you both. Good evening.